Okay, so let's look at Morris dollar value LIFO. All right. So it says Morris uses dollar value LIFO, computes the year 8 inventory. So obviously, year 5 is the base year, right? How do I know that? How do I know year 5 is base? Because the index is 100. So I know that's base. Okay. All right. And then year 6. So they want us to calculate the dollar value LIFO inventory at year 8. So year 6, the inventory at current cost is 11,845. The index is 103. So remember, first thing we have to do is reduce that down to base year prices. So we do that by dividing by 1.03. So 11845 divided by 1.03, or multiply times 100 over 103, same thing. So that gives me an inventory at base year prices of 11.5. And then I compare that to the previous year, and I see that my inventory has gone up $1,500. And notice that that's why I have to convert it to base year. So this is base year prices. So I have to take the current year, strip off the inflation, so I can take this back to base year prices so I can see if the inventory went up or down without regard to the price increase. Okay, so I have to convert it to base year prices and then see if it went up or down. So then I have the change. So the change is that I went up $1,500. If it increases, that's a new layer. Okay, because this is LIFO, last in, first out. So that means I have to keep my inventory in layers. So I still have all my $10,000 layer at base 100, and then now I have 1,500 that is base 103. So I'm going to convert that back in order to get my ending inventory. So that's 1,545. So my ending inventory is 11,545. And then if I'm keeping my layers, I now have the $10,000 at base 100 and the 1,500 at 103. Okay, makes sense? All right, and then year 7, what happened? Year 7, the inventory is 12,096. Okay, first thing I have to do, convert it to base year prices. The index is 108. So I have to strip off the 8% increase. So 12096 divided by 1.08 is 11,200. Then I calculate my change. So comparing it to the last year, what happened? It decreased by $300 at base year price. Okay, so exactly. Now I have to figure out, okay, so I spent some of my previous inventory. Which layer does it come out of? Last one, because I'm LIFO. So the last layer was the 103 layer. It had $1,500 in it, so I spent 300 of that inventory. So that 300 gets converted to 103 because that's the layer it came from. So 300 times 1.03 is 309. And of course, that's a negative number. So my inventory is now 11,236. and then to keep up my layers. So now I still have the $10,000 layer, and I only have 1,200 left at 103. I multiplied it. Oh, I subtracted it from the previous inventory. I'm not one. Well, it's actually a multiplication. It's just that over here you're dividing it because it's the denominator, and here you're multiplying because it's the denominator. I had what? This. To the left. Okay, right. So it's a multiplication. So you're multiplying that times that. So it's actually both of them are multiplied. And I'm saying divide because it's the denominator. So the quickest way is to divide it, but it's actually a multiplication. Okay, so next, so year 8 is 13,090, and the index is 110. So I have to convert that. That's 11,900. Calculate my change. So it went up from last year by $700. So since it went up and it has a new price, I have a new layer. So I multiply that back times the current year price, which is $770. Add that to my previous inventory, and my inventory is $12,006. And that's what they wanted to know, is what is the year 8 inventory, $12,006. Yeah, and then if I were going to continue it, yes, I would just write down my new, well, now I have 3 layers. So I would just add my 700 at 110. So that's my 3 layers currently. All right, then the next one is number 32. Let's see, this is a moving average. Any questions on dollar value LIFO? I'm not going to do the retail one, just this one, just the dollar value LIFO. So the next chapter had dollar value LIFO at retail method. So, but I'm not going to do that. So out of that chapter, I'm only going to do the gross profit method and the cost to retail method, not the dollar value LIFO. It's too hard. Okay. And you may never see it anyway, because that's pretty far out there. So you may never see that in practice. Actually, I've never used it in practice. I've only worked these problems in the classroom. Okay, so moving average cost flow assumption is what? Remember, you have FIFO, LIFO, average costing method, and then FIFO, LIFO, move it average costing method. So actually, the periodic one is called the weighted average method. But in the perpetual, it's called the moving average method. So this is perpetual because it's moving average. It may say that. No, it doesn't say that. But it's the moving average assumption. And what that means is every time you buy a product, the average moves. Okay, so it's weighted average for periodic because remember, we take the entire period, month, year, whatever it is, and we calculate a weighted average. But for perpetual, because we're calculating a new average every time we buy, it's called a moving average. Okay. All right, so January the 1st. Is everybody good with this? January 1st, We had 180 units. Is everybody good with this? Do I need to work this problem? This is a perpetual moving average method. Okay. All right. So, okay, 180 units. Inventory. The total inventory cost was 900. So we start out with 180, and it's 900. So whatever that is. Is that the way you read it? So it's a $5 cost. That's our beginning inventory. And then it says on January 10th, 40 more units were purchased at a cost of $6. That 6 is 240, right? So, and remember, it's a moving average. Every time we buy, we calculate a new average. And the way we do that is we take the old units plus the new units. So we have 220 now, right? And we take the old cost plus the new cost, so 1140, and we divide it to get an average. $5.18. 18 to go. I'll go 4 decimal places. Okay, so that makes it 180 before, and I just bought 40 more. Okay, so what you're doing is you take your total number of units, add your new unit, your old cost plus your new cost, and you calculate a new average. This is how much inventory you have, units and cost, and you calculate a new weighted average or a moving average. $11.40 divided by 220. So all you're doing is calculating a new average. You had 180 units that cost 900, so I calculated that at $5 a unit. And now I bought 40 units, so now I have 220. I had $900. I just spent another 240. Now I have 1140, and I just divided it out to see what the average. So I just calculated a new average. Okay, no problem. Okay, then let's see what happened. So I want total cost of goods sold for total cost of goods sold for the unit sold on January 17th. So that was okay, a purchase, and then on January 17th, I sold 20. Oh, I sold 20 units on January 3rd. Let's see, I bought these on that was January 1st. Oh, I didn't buy these until January the 10th. Crap. All right, wait a minute. So they're not in order. Confusing. All right. So I purchased those on January the 10th, but I bought 20 units I sold 20 units on January the 3rd. So I need to sell those before I calculate my new average. Okay, they're out of order. All right, so I sold 20 units. So now I have 160 at 800. So they're still $5, but I sold 20 units. Right, because that was only or that was the last average cost. Every time I sell, I use the last average cost. All right, so now I have to recalculate my average. So $5.20. Then what happened? Then on January the 17th, I sold 60 units. And I'm going to use the last cost. So $5.20. So what is that? 420? So 60 times 520, 312. That's what I get for trying to do things in my head. Okay, so 312 is my cost of goods sold on that for that January the 17th sale. On the 17th, yeah, and that's what they asked us. What was the cost of goods sold on January 17th? They used my blood at Pikeville Medical Center. So I just got a text. Pretty cool. So somebody got jet fuel. Accountant blood, jet fuel. Okay, questions about that? Can do. Moving average method. All right, so that's the end of chapter 7. Then chapter 8, moving average method. No, not LIFO. It's perpetual moving average. All right, and then chapter 8, that was 2 problems I wanted to go over. Number 12 and number 17. Okay, so this is the cost retail inventory method, cost to retail. All right, is everybody good with this? And we need to know if is it FIFO or is it average? It's average cost to retail method. So what that means is we're going to add the beginning inventory plus the purchases, and then we're going to calculate the cost to retail. Now, if it was either LIFO or FIFO, we would have to keep the layers separate. But this is average, which is the easier one. So that's why I picked this one, the easier of the methods. Okay, so our beginning inventory was, and we have to keep them separate, so cost and retail. So 28,000 cost and 34,000 retail. And then it says we purchased, so this is beginning, this is purchases, 108,000. And the retail on that was 137,750. Then what happened? So we sold some stuff. All right, net markups and markdowns. So net markups, we're going to add to retail because that's just the pricing. So we're going to only on the retail side, nothing to the cost side for markups and markdown. And the markdown was 7,500, so that's going to be a negative. So here is our total cost. So what is this? 136,000. So that's our goods available at cost, and then our goods available at retail. Yes. You don't have it pulled up? Yeah, it's on the problem. Okay, so now I have my goods available. I need to get my percentage. Oh, and that's what it's asking us for, isn't it? It's the percentage. 136 divided by 185,750, 73.2%. So that's your cost to retail percentage. So if we wanted to continue this, and we should, right? We should continue this. Yeah. Okay, so this is what this problem is asking for, is the percentage. But in order to finish the problem, to find out what the inventory would be, we would take our sales of 156.9, which is theoretically at retail, right? Except for the employee discounts. Employee discounts are 14.5. So if I want to get that to full retail, I would add the employee discounts to the sales, right? Because that's how much the sales have been reduced below retail. So if I wanted to get sales at full retail, I would add the employee discounts in. So that means my sales at retail are 171.4. So that means that my ending inventory at retail would be the goods available minus the sales. So $14,350 would be my ending inventory at retail. If I want to convert it to cost, I know what the average percentage is. So cost is 73.2% of retail. So that means my ending inventory at cost is $10,504. And that makes sense, right? Understand the whys and you can rebuild the whats. So that's how I can remember how to do this, is because it makes sense how you go about it. You're just calculating your total cost at goods available and your total retail goods available, and you're getting an average percentage. And then, because you don't know your ending inventory, but you know what you sold. So you take your sales plus your employee discounts, because that was what you gave employees off below retail. So sales at full retail would be 171.4. If you subtract that from your goods available at retail, then that should be how much is left at retail. No, you multiply. Yeah, so your cost is 73.2% of retail. So you take that percentage and multiply it times the retail, and that gives you your cost. Right, that your goods available minus your sales equals your ending inventory. And that makes sense, right? And the reason you would use this is, for some reason, you couldn't count the inventory. So like if you were doing an interim financial statement and you didn't count the inventory, so maybe you only count at the end of the year. So it's March and you're trying to do a financial statement, and so you're trying to calculate your ending inventory. So you could use this method. Or the warehouse burned down and you don't know how much inventory was in there. You could use this method to estimate the ending inventory. Okay, makes sense? All right, and then number 17. All right, and then this is another method for estimating ending inventory. This is called the gross profit method. All right, is everybody good with this? That makes sense, right? Gross profit method. And we're going to do the same thing, except instead of taking a cost to retail percentage, we're going to take the gross profit percentage and then estimate the cost of goods sold. And then we can estimate, because we know the formula for cost of goods sold, we can estimate the ending inventory, right? Okay. All right, so they're using the gross profit method to estimate inventory for interim financial statements, because they don't count at the end of the quarter. They only count at the end of the year, probably. It says following information. So the inventory balance at January 1 is $12,500. And then purchases are $25,000. So there's our goods available, $37,500. And it says sales during January are $24,000. And then it says the markup on cost is 50%. So then that means that the cost of this would be that number divided by 1.5, right? Because we mark up 50%. So to convert that to cost, it would be 16,000. Divided by 1.5 or 150%, because it's 50% mark on cost. Okay. Right. So if your sales are 24,000 and it's marked up 50%, then your cost of goods sold is 50% less than that. Okay. So, and of course, if you know your goods available and your cost of goods sold, you can calculate your ending inventory. Okay. So there's your goods available. This is how much you sold. So your ending inventory is what, 21.5. Subtract your cost of goods sold, and that gives you your ending 21.5. Okay. So that's the last thing I had. So does anybody have anything from the midterm exam that we need to go over? That'll be good with all that. Number one, the T chart. Nathan Company, the T chart. Oh, is everybody good with this? Okay, so, all right, Nathan pays rent in advance in some cases, and in some cases after the rental period expires. So some is prepaid and some is payable. So what we need to do is draw the T account for the prepaid and for the payable, because what they want to know is how much rent expense we had. So we have prepaid rent and rent payable. All right, so it says prepaid rent at December 31st, year one, is debit or credit? Debit, okay, because it's an asset. All right, so year one, it's 70,000. Year two, so the beginning of the year, it's 70,000. End of the year, it's 30,000, right? We see why I'm writing it like that? Okay. Rent payable, debit or credit? Credit, because it's a payable, right? Okay, so year one was 50,000. Year two is 35,000. Okay, and it says we paid 200,000 in rentals, and of course, some of the paid would go here, and some would go here, right? Some would be prepaids and some would be payables. We don't know which, but it don't matter. So I'm just going to throw it on one of them. So I'm going to throw it over here and say 200,000 right there. So if that's how much we paid, that would be 270, and then I got to get down to 30. So that means the expense would be what, 240? Okay, because in order to get the expense, I'm going to have to credit prepaid and debit rent expense, right? And then over here, if it was 50,000 and it went down to 35, that means I have a debit of 15. So that means I'm going to have to credit over here. So my rent expense is what, 225? That makes sense. And I could have done the 200,000 on either one. Probably would have made more sense to have done it on the rent payable, because then I wouldn't have had a credit to my expense account. But what it's trying to teach you is the relationship between prepaid and rent payable and rent. And if I'd done it over here, it would have come up the same. Let's do that. So here, so if I put my 200,000 here, in order to get down to 35, I would have to credit this for 185, right? I would credit this for 185, which would be a debit to rent expense. And then here, in order to get down to 30, I would have to have a credit of 40 and a debit of 40. So that would get me to my 225. So it doesn't matter where I put the $200,000 payment, it's still going to come out the same. $29. Okay. Okay. Somebody good with this? Did you get this? Okay. Okay. All right. So 29. Dallas had a 600,000 sales, cost of sales 430, interest 12, gain on sale of a component, where its income statement uses the single step format, all inclusive concept. What is the pre-tax income from continuing operations? So, so pre-tax, so ignoring the income tax, and it's income from continuing operations. So we don't care about the gain on sale. So if we want income from continuing operations, the gain on sale is something that's no longer continuing; it's discontinued. We sold it. Okay, so we ignore that. So it's going to be the 600,000 minus the cost of sales of 430, which would give us 170, and then interest expense, so 158, because we're going to ignore the gain on the sale, or yeah, interest expense, yeah. So we just want pre-tax income from continuing operations. That would be 158,000. And you should, in answering this question, you should say, I don't include the gain on sale because that's not continuing. It's been sold. So you ignore that. Oh, okay. Okay. Anything else you want to go over? Okay. All right. Well, I'll stop this one then, and we'll just spend the rest of this time on cost. Why it's not going to be here anyway, he asked me to record. So.